Hey everyone, welcome back to Kitco News. I'm Jeremy Szafron. The Federal Reserve has cut interest rates by 25 basis points, bringing the target range to 4.5% to 4.75%. Now, this decision was unanimous, with few surprises in the statement. The Fed acknowledged a slightly weaker labor market and shifted its language on inflation, removing its references to, quote, further progress and describing inflation as somewhat elevated. That's a move analysts say could hint at a less dovish stance in the months ahead. But things got heated once Fed Chair Jerome Powell took to the podium. Powell faced tough questions about how the president-elect's new economic policies might impact the Fed's projections and whether he'd be willing to step down if asked by Donald Trump. Let's listen to that exchange.
At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4.5% to 4.75%. We're trying to steer between the risk of moving too quickly and perhaps undermining our progress on inflation, or moving too slowly and allowing the labor market to weaken too much. In the near term, the election will have no effects on our policy decisions. We don't know what the timing and substance of any policy changes will be. We therefore don't know what the effects on the economy would be, specifically whether and to what extent those policies would matter for the achievement of our goal variables, maximum employment, and price stability. We don't guess, we don't speculate, and we don't assume.
Some of the president-elect's advisors have suggested that you should resign. If he asked you to leave, would you go?
No.
Can you follow up on, do you think that legally you're not required to leave?
No.
And now, according to my next guest, there's a larger issue looming here. He argues that the current debt situation is so severe that no administration can solve it, pointing to potential surges in gold prices even as high as $6,000 to $8,000 an ounce within this current bull cycle based on historical patterns. Joining us to discuss this is Brien Lundin. He's the editor of the Gold Newsletter and the CEO of the New Orleans Investment Conference, the world's oldest and one of the most respected investment gatherings, now celebrating its 50th anniversary this November 20th through November 23rd. Hey, Brien, welcome back to Kitco News.
Great to be with you again, Jeremy. Thank you so much.
Nice to see you as always. Okay, Brien, we just watched a very lively press conference where Fed Chair Jerome Powell was facing some tough questions. First, what do you say to those analysts who say that the Fed's wording around inflation could mean a less dovish stance come December?
Well, I don't know that there was much of a difference in the wording from this meeting to the last, just a couple of words here and there. And of course, they're always leaning on the data-dependent verbiage and out there. So I don't think he's leaning either way. I think another rate cut is baked into the cake. And more importantly, I think that successive rate cuts are baked into the cake because of the tremendous cost of servicing the federal debt at these interest rate levels, and that debt rate tsunami that's kind of off the economic coast right now on a corporate level for corporate debt. We're going to see a lot of debt resets coming up in the months just ahead, and companies and corporations have trouble or had trouble paying those debts, servicing those debts in a zeroed interest rate environment. They will find it nearly impossible to service those debts at current interest rates. So the Fed really has to get rates down. And the longer it waits, the more urgently it will have to do so at some point.
Okay, so the 25 basis points, I mean, a lot of analysts were calling it. I think the CME FedWatch tool was pretty accurate on that call too. How aggressive is the Fed likely to remain with its rate cuts here?
I think it's not too aggressive. I think they're going to have to continue. But they're also worried a bit about the signal that they're going to deliver to the markets if they go too quickly. So I would expect quarter point cuts from here on out. I think that initial half point cut left the markets a bit bewildered and wondering what the Fed was thinking and what it was worried about. What we're seeing right now, though, with Treasury yields rising is that the markets and investors really around the world are worried about something. And the Fed is trying its best to convince the public that it's not worried and that it's on a good path right now. Mm-hmm. I think those two dynamics are going to conflict at some point in the months just ahead.
Yeah, Brian, I mean, can the Fed afford 0% rates? I mean, will the market even let it go down this low again? I mean, what impact would that even have on inflation? How do you see this all playing out?
Yeah, it's interesting. What we're seeing right now is the rise again of the bond vigilantes. Market, in effect, telling the Fed that current rates aren't appropriate for the amount of risk that the market sees ahead. Now, what's really interesting is what are those risks that the market, that bond investors see ahead? Powell himself said that he didn't believe it was inflation expectations, and I agree with him. If investors were worried about inflation, then we wouldn't see the dollar strength we've had recently. So that's the interesting part to me. I think that investors are worried not so much about inflation, in other words, but I think they are worried about the ability of the U.S. to keep financing and servicing the debt at these levels. And that's a different animal. It really is. In that kind of environment, they would bid up yields on treasuries, but they would run to the safe haven of both the dollar and gold. And that's really what we're seeing in the markets lately.
Yeah, interesting. I mean, we're going to unpack the debt load because there's a lot of it. But what are your thoughts on the Fed not taking into account the new administration's policies yet? I mean, is the Fed behind the curve, in your opinion, here?
No, I think they have to be politically neutral and they have to fend that off. That was the most interesting part of the press conference, as you gathered from the clips that you chose. What was interesting to me, though, is that Powell absolutely knew those questions were coming. His first statement on the new administration's policies, in fact, he read from the podium in response to that question. So he was very well prepared for that and to fend that off. That was the most interesting thing I saw about it. They will respond to policies, but only from the standpoint of how they think that's going to affect their two mandates.
Mm-hmm. Yeah, let's switch over to the macro outlook here, Brian. I mean, I was reading your latest newsletter. We'll get into that too. But what is your macro outlook going into this year end and, of course, early next year? I mean, it's been an interesting year, my friend.
Yeah, it has been. The employment numbers are a bit iffy right now in the U.S. There are a number of analysts out there who believe that we're already in recession. And that's the way it works. They don't call a recession until after you've been in it for a while. So that remains to be seen. I don't really have a strong opinion on that. I do think that the primary issue that we're facing right now on a macroeconomic standpoint is, again, the debt and the ability to service that debt. We are going to continue to roll up very large outsized deficits. The Trump administration didn't mention that, neither did the Biden or the Harris campaign mention at all the debt and the problems of servicing the debt during the campaign. So there doesn't appear to be much of an inclination to address that in the upcoming Trump administration. So that's going to continue to happen. I think that's going to be the overriding issue, frankly, as we get into the new year.
Okay, well, let's talk a little bit about this debt situation, Brian, because it is large. I mean, your thesis is that this is, an end to more than 4 decades of easy money policies with even greater debts. And we're at the point where the world is increasingly obvious. We can really see that debt now. The U.S. national debt is about to hit $36 trillion. Servicing that debt will be unsustainable. So how do you see this all playing out? And what are the biggest risks next year?
Well, the risk is that confluence, that conflict between the cost of servicing that debt and the rising debt. I think the rest of the world is going to watch very closely Trump's spending plans. Mm-hmm. And if they remain on course with what the Biden administration has done, which won't be easy to do because they were spending wildly over the last year and really running up that deficit. So it won't be easy for Trump to keep up with that pace, but I think he can manage it. In fact, what we've seen over the past couple of decades is that each 8-year span of presidential administrations has essentially doubled the federal debt. When Trump got into office in his first administration, I presented that fact and noted that in my presentations and writings at the time that we would likely be close to $40 trillion in debt when in 8 years. I didn't anticipate the fact that Trump would not have a second administration at the time, but we're really on pace to be pretty close to that. We will be about $38 trillion in debt. So what does that mean? If we double that over the next 8 years, it's going to get really ridiculous. And my view has been that there's going to be a crisis baked into the cake because of all of this. We had the great financial crisis in 2008. The COVID crisis came, but there was something happening back then, even before COVID, because the Fed essentially returned to quantitative easing months before COVID hit. So we've got these cycles coming up, and at some point, the Fed's management of the price of money is going to create the next crisis. And when that happens, they're going to be forced to get back to zeroed interest rates. You know, you mentioned, can the Fed afford to get back to zeroed interest rates? I think at some point they're going to have to get back to that. And moreover, they're going to have to institute not only quantitative easing, but other fiscal and monetary rescue efforts that will dwarf what they did the last time. And each cycle, they have to do much more than they did before to get the same effect on the economy and the markets.
Yeah, you know, Powell was asked about U.S. debt today in the press conference, and he did admit that, quote, the path is unsustainable, it's important to be dealt with, and it is ultimately a threat to the economy. Let's take a listen to that one.
I have said many times, no more, no less than what the predecessors you mentioned have said. And what that is that the U.S. federal government's fiscal policy is on an unsustainable path. The level of our debt relative to the economy is not unsustainable. The path is unsustainable. And we see that in, you know, you've got a very large deficit you're at full employment, and that's expected to continue. So it's important that we, you know, that to be dealt with. It is ultimately a threat to the economy. Now, I can say that. I don't have oversight. We don't have oversight over fiscal policy. I've said it on many occasions, just said it again.
Yeah, obviously a big statement coming from the Fed chair, who always says that the Fed doesn't have oversight over this. So what are your thoughts on Powell's comments here?
Yeah, he has said that over and over again, virtually the same statement. Unsustainable path, it's fine right now, but the path is unsustainable. Now, there's two things to know about that. One is whether things are fine right now. At the current moment in time, the U.S. leads the world in federal deficits as a percentage of GDP. No other country is at our levels, even Japan. So that is, you know, that counters his argument that things are fine right now. They may already be unsustainable at this rate. The other elephant in the room is no one seems to ask Powell, well, do you think we will ever be able to address that? No Congress, no administration, no politician that really wants to stay in office has ever addressed that issue or been able to address that issue. So the record shows that spending will continue at or close to the current unsustainable path or pace. So at some point, it will be an unsustainable situation at the current levels. Mm-hmm. So the direction is clear. The trend is clear. The timing of when that reaches a crisis level is always the tough part. We don't know when that's going to come. But my argument has been that with the trend clear and the detail, the path ahead uncertain, the one thing we can be fairly confident in is that you want to own, or you will want to own, gold, silver, the monetary metals, and the associated investments.
Mm-hmm. Yeah, of course, we're watching some crazy price movement on gold, too. We'll get into that. But quickly here, Brien, I mean, you mentioned that the Fed will have to respond to the next crisis. You just mentioned we don't know what the timing of that be. Well, how are they going to respond? I mean, what does that look like? Just more easy money policy? And then again, how's that going to impact inflation and then the dollar?
Yeah, you know, it's going to make your head spin, Jeremy, what they do the next time. I mean, consider one of the charts I show in my presentations is the stair-step pattern of ever lower interest rates since Volcker started lowering rates in 1980 after he essentially killed off inflation. And once they had to go to zero in 2008, then they had to come up with something else. They had to come up with quantitative easing. Mm-hmm. So they had to do more than they had ever done before to get the same effect on the economy and the markets, because essentially the addict had developed a tolerance for the drug. So greater dosages were needed to get the same effect. Then came COVID, and they did everything that he did over 4 to 5 years in 2008, post-2008. They did in 4 to 5 days post-COVID with the COVID shutdown. And they immediately doubled the Fed's balance sheet. They actually injected the monetary adrenaline directly into the veins of the U.S. economy by depositing money into bank accounts. So they had to do so much more. Now, that begs the question, what more can they do? Well, we're going to find out in the next crisis, because whatever they do, it's going to have to make everything else pale in comparison. So it's going to be dramatic. And my longer-term thesis has been that with each one of these successive cycles, the credibility in the currency is damaged. The currency loses credibility with each cycle. So that means at some point you're going to have to reestablish some credibility to the fiat currency, to the dollar, and really other fiat currencies as well. That's why I believe that eventually there's going to be a reset that's going to involve gold in some way.
Mm-hmm. Well, let's talk about that. I mean, when it comes to the U.S. dollar, what are some of those key triggers that investors should be watching carefully for over the next year in terms of the state of the U.S. economy, and then, of course, the fiat, the dollar?
Yeah, the $100 level, rather, and the dollar index is a key support level. We played around with that a while back, but didn't really break through. So I think that, from a technical standpoint, is a key level. Mm-hmm. But again, the dollar is a safe haven play globally. So I don't know that we need to have a much weaker dollar to see gold prices rise and therefore silver prices rise. In fact, the last year, this bull market, and even the last year, has been peppered with a number of periods where Treasury yields were rising, the dollar index was strengthening, and gold was rising. And gold has risen when both were weak. So gold has been the all-weather investment, the one thing that has powered through really every scenario. Mm-hmm. And I believe that the periods when the dollar were strengthening and Treasury yields were rising and gold were rising were a sign of these bond vigilantes coming back to the market and expressing some skepticism about that debt situation.
All right, so Brien, let's switch over to gold, because gold and silver prices have recovered on Thursday after Wednesday's sharp losses. The gains come amid a weaker U.S. dollar today and follow a decisive victory by presidential candidate Donald Trump, which has sparked a renewed appetite for risk in the market. Right now, spot gold is trading at around $2,700 an ounce, while spot silver is at about $32. In fact, gold prices are on track for their best gains since 1979. And you've said in past interviews that money is moving into gold for bigger and more fundamental reasons. So what's your year-end, early 2025 price outlook here?
Yeah, that sell-off we saw in the immediately post-election was, I believe, traders seizing on some factoid, some rationale to sell gold short and silver. And I think that was the belief that there was some geopolitical premium built into the gold price at the time. A widespread belief that some investors were buying because they thought there would be some kind of turmoil, post-election riots in the streets, etc. So Trump's clear victory negated that perceived risk, and traders jumped on that to short gold, and the sell-off accelerated. Mm-hmm. I believe that was merely a short-term phenomenon, and today's action is kind of proving that correct. Because fundamentally, I believe that the buying in gold over the last year has been from bigger sources for bigger reasons. I think there's been a growing unease around the world. I think big portfolios around the world have just subtly shifted perhaps not even whole percentage points toward gold, just very small allocations, getting some of that gold hedge into those portfolios. Mm-hmm. And the key is that there's such large, really massive oceans of liquidity sloshing around the world right now that even a very small shift toward gold of that money into the relatively small market that gold and especially silver are really creates outsized reactions. So what we've seen is that kind of money looking for a gold hedge, and not just the central banks, which is an entirely different story, but really just portfolios trying to get that gold hedge. It's really powered this market. And in short, I don't think there's been a geopolitical premium in the price. And that's being proven out really as we speak.
Yeah, I mean, what's the new price floor for gold? I mean, it's as you mentioned, really stable.
Yeah, I hesitate to say that because I don't want to jinx it. Because if I
knock
say
on
that,
wood,
we'll fall right through it. But that $2,700 level we've just regained, and I think it took really significant shorting or selling to drive it through that floor. And as we see, we've quickly regained that. So I think that's the new technical floor. 2,800 we've touched on the futures basis, but not quite on the spot basis. But I really think gold on a spot basis is taking aim for 3,000. The question is when? Is that going to be before the end of the year or early next year? I think by early next year we'll get to that point. But this is a pretty clear trajectory right now toward I think significantly higher levels for gold.
Yeah, Brien, explain what's been going on these past few weeks with gold going up at the same time as the dollar and rising yields.
Yeah, they're supposed to be inversely correlated. And I feature a chart in my presentations and writings showing the rolling 20-day correlations between the dollar index in gold and between the 10-year Treasury yield in gold. And you'll see over the past year, again, that there are periods where that correlation has been positive for both, really. It's interesting. It is as interesting as the fact that gold has decoupled from real yields. When real yields have been positive and rising, that's usually a point or time when gold prices are weak. And instead, gold has been rising even as Treasury yields have been rising. I think that's a recognition that higher interest rates are simply incompatible with debt loads as high as they are now. That they cannot be managed. These debt loads cannot be managed with anything approaching normalized interest rates. And the interest rates that the Fed has recently reached or elevated rates to over 5% are still low historically. And the economy and the markets and companies and the federal budget can't even survive those. So my bigger term, longer term, bigger picture view is that with debt loads this high, we have to have negative real rates. We have to have interest rates, the cost of servicing that debt, lower than the rate that the currency is depreciating. In other words, the inflation rate. Otherwise, the entire house of cards collapses. Negative real rates, if we can achieve those, and I think they will be necessary, are very bullish for metals, for commodities, for tangible investments.
Yeah.
So that's one of the reasons why I'm very bullish on gold for the longer term. The other side of the question is, can the Fed lower rates when you have the markets saying that, no, we don't want those kinds of yields. Those yields that you're pushing aren't compensating us enough for the risk we see ahead of not only inflation, but your ability to service that debt. So that's the big conflict that I see coming up ahead. And I don't know that anyone can predict the outcome of that, frankly.
So it sounds like we're kind of at the early innings of this bull market cycle. So based on past cycles, where do you see gold at the end of this one? I mean, if we're just at the beginning here in this current bull market cycle, where's gold going to be?
Yes, we're literally in uncharted territory now. So what I look for as some guidance is what have past secular, long-standing, monetarily based bull markets done. And my count is really since the history of gold as an investment and not money, meaning post 1971, there have been three major bull markets in gold: the early 1970s, the late 1970s, and the 2000s. And in each of those bull markets, we've seen gold go up either from 5.6 to 8.2 times from the lows of the bottom of the cycle. If you put this low of this cycle at around $1,050, that means at the end of this cycle, we should have a gold price anywhere from $6,000 to $8,000 or more. The question then is, of course, what's the timing of that? When do we see prices like that? And I can't venture a guess. I don't think anyone can, but we can hope that it takes a good long while so we can make a lot of money from not only the metals, but the associated mining equities.
Yeah, well said. But how do you go about figuring out the timing of bull cycles? I mean, what signs do you watch for in terms of determining whether it's at the beginning or the end?
That's a very good question. I look at the fundamentals. A lot of people look at the technicals. I look at the technicals a bit here and there. One of the things I've noticed is the ebbs and flows of this bull market have been very regular, and that we've had surges lasting about 3 weeks, and then we've had corrections lasting about an equal amount of time from a short-term basis. But from a big basis, from a macro basis, it's harder to pick the top. I think we can all see and agree when metals are undervalued and at the low point of the cycle. But the key is to know when to sell. And that's going to be tough. That's going to be tough. But I don't think it's going to come until we get to levels like I just discussed, because this is the end of a multi-decadal trend of ever easier money. And it's going to get resolved at some point in the years just ahead. And we don't know when that's going to be, but we do know that we want to own gold going into it. The top is very likely to be in this cycle when we see governments seek to make gold official or tie their currencies back to gold in some official way. I think that may represent a top in the market, but that's far from where we are today, both in price and time, I believe.
Yeah, we learned from the latest World Gold Council report, too, that Western investors are coming back to gold. How significant is this shift?
Yeah, it's very significant. The first month and a half or 2 months of this bull market were driven by really unique factors for gold. It was central bank buying and domestic Chinese buying. And we really didn't see the Western investors involved because they couldn't take those factors and project them very far in the future. But then as we got to midsummer, Western investors saw the big factor that they had been expecting. The Fed pivot was coming up, and they started to price that in. So now they're in, and they're jumping in. And they first came in the gold ETFs. We saw funds starting to come in, inflows instead of outflows of the big gold ETFs. Then in August, we saw the Western investors start to come into the big mining equities. And we just started over the past few weeks to see that filter down further down the food chain into the juniors. That's good because that's going to power the market ahead. That's the kind of money we need to really move this bull market higher. But it does bring some wiggles in the uptrend line. We got spoiled in the early stages of this bull market because the uptrend was virtually relentless with no sell-offs, just higher and higher every day. Now we're getting those ebbs and flows, those two steps forward, one step back. And that's the kind of market that will test your commitment to it and your convictions, but it also creates buying opportunities along the way. I think we saw one of those right after the election, and undoubtedly there will be more to come.
Yeah, and investors, I mean, there's some fresh blood there. People are looking for these haircuts on the deal side. Okay, well, let's switch over to New Orleans because it's an exciting time. First held in 1974, the New Orleans Investment Conference is the world's longest running and most respected investment gathering. Every year, it offers dedicated investors an in-depth look at the trends shaping U.S. and global markets, and it also offers valuable insights and a clear outlook for the economy and the investment landscape. Its goal is to prepare investors to position their portfolio strategically, reduce risk, of course, and then maximize returns for the year ahead. Congratulations on reaching the 50-year milestones for the conference here, Brien. Talk to me a little bit about the origins of this event and what makes it, what it was like in the early years. I mean, 50 years is quite a while.
Yeah, I wasn't around in the earliest years. Yeah. I've only been around for 39 of those 50 years. So
still good.
A relative newcomer, as it were. But the conference was started by Jim Blanchard, who was really a pivotal force in the sound money movement, the hard money movement of the early 1970s. He, more than anyone else, was responsible for getting gold legalized for ownership in the U.S. A lot of people don't realize it was illegal to own gold in the early 1970s, really post-1933. It was as illegal to own gold as it was any drug or plutonium or any other dangerous substance. Citizens weren't trusted to own it. And when Richard Nixon closed the gold window, severed the last link between the dollar and gold in 1971, Jim started Gold Newsletter as a tool to lobby for the return of gold ownership. And long story short, he was successful and they were signing the law in 1974 to allow citizens to own gold. So Jim decided to have a conference to teach American investors how and why to buy gold. He had that first conference in 1974 and then just had it annually for years afterwards. And it grew to become the most prestigious investment event in the United States, if not the world. A number of giants of recent history have graced our stage, from Lady Margaret Thatcher to Ayn Rand in her last public appearance, Alan Greenspan, Milton Friedman, F.A. Hayek. The list goes on and on and on. And Jim passed away in 1999, and I've been kind of carrying the torch for him ever since and trying to build on that legacy. We bring in, or we focus on bringing in the best thinkers out there, and we have a focus on quality and content that I think leads this industry of investment events, and people can see that if they look at our speaker roster year after year. So this year we pulled out all the stops. It's our 50th anniversary. You have another really wonderful faculty of speakers coming, from Jim Grant to George Gammon, Rick Rule, Danielle DiMartino Booth, Brent Johnson, Jim Iorio, Peter Bookvar, Jim Bianco, James Lavish, on and on and on. Literally dozens upon dozens of the top thinkers today, and people that can give us the kinds of insights we need. Extraordinary minds at an extraordinary time in the markets. We also feature a exhibit hall filled with about 90 of today's best junior mining companies and opportunities there. And you have a one-stop shop opportunity to get great advice from independent experts, and also look for the best way to leverage these trends in their strategies.
Yeah, well said. I mean, looking back over the past 5 decades, we have a little bit of a runway here to look at through history. What are some of the most defining moments that stand out for you there?
Well, the conference has a long history of forecasting major pivotal events. You know, as I prepared for this 50th anniversary, I've gone through and looked at a number of presentations over the decades. And in every case, we've had some really smart people talking about events or predicting events that eventually came to pass. What's been the tougher part, again, has always been the timing. But every major turning point in the markets, every major crisis, every major opportunity was foreshadowed, was predicted at our conference by these experts. So I think the takeaway is the trend more than anything else, and in the value of that information. It's something where you can get conflicting information sometimes at our event, and you get to make your own decision. You get to weigh the pros, the cons, the conflicting arguments, and come away with, I think, a much better picture of what the major investing trends are, and how, more importantly, how you can take advantage of them.
Yeah, I mean, the macro community has changed so significantly too. Okay, well, as you celebrate 50 years, where do you see the industry heading in the next 50? I mean, we've been talking about all-time highs on the gold front. We know that precious metals aren't going anywhere. We're talking about this commodity super cycle just at the beginning stages. I mean, given what's happened in the economy, we got the geopolitical situations. Where are we going here?
Well, I hope you're not asking me for a 50-year prediction,
Of
which I'm
course.
glad to offer up, because none of us are going to be around to prove me wrong. But yeah, again, the trend is what you need to focus on. And since we cut the last tie between currencies and gold, what we've seen is that central bankers, they've been like giving the keys to the car and a bottle of whiskey to a teenager. They run this thing out of control. They've been able to expand deficit spending really without restraint, and it's been a cycle that is now coming to a head. So I think that we will see some resolution of that cycle in the years ahead, whether that's over the next few years, whether that's over the next 10 or even 20 years. We again need to recognize where we're headed with that. Currently, we're at a situation where the debt is unmanageable, and increasingly, that's something that's becoming increasingly obvious to the broader markets. People who come to my conference and other conferences, people that watch your program, are really ahead of the pack, because they've learned about this over the last few years and even before that. And again, the timing is the hard part, but we have been on the vanguard. This little community of people who invest in metals, miners, crypto, and the like, see where we're headed, and they are ahead of the rest of the world in seeing that. So you need to be positioned for that. And you're doing a good job, and this community is doing a good job of exposing investors to ways to not only protect themselves, but profit from these trends. And it's going to be interesting. Things are accelerating now. It's going to move quicker now. And I think all of our well-laid plans will come to fruition as far as protecting ourselves and being positioned to profit from what's about to happen.
Yeah, well said. Well, we're excited. Kitco News, of course, will be on location at the conference as well. Speaking to all those experts you just mentioned, we're lucky enough to have them. Brien Lundin is the editor of the Gold Newsletter, also CEO of the New Orleans Investment Conference, joining us. We'll see you there, my friend. I appreciate the time today, as always.
Looking forward to seeing you down here, Jeremy.
Yeah, excited about it. Thanks, Brien. See you in New Orleans. Appreciate it. I'm Jeremy Szafron. For all of us here at Kitco News, thank you for watching. We've got great content coming up all week long, so hit that notification button. Stay tuned, and we'll see you next time.